Sam Gruen, what a pleasure to finally meet you. Welcome to Real Vision.
Pleasure's mine, definitely, and thank you very much for having me here.
So why don't we begin with telling the viewers a bit about your background?
Born in France, half American, studied here, and then at the end of my master's degree, went to the UK to get some experience before coming back, getting a PhD. Typical thing, emailed 150% to get an interview, got 3, 4, and finally got one with a hedge fund called Gruen Capital, and did my internship there. And at the end of the internship, they told me, your internship's over. We're not going to renew your internship, but we'd like to hire you, which means you have to give up your PhD. Took me about 24 hours to decide. So having one foot into the door of a hedge fund at 21 was like, well, for me it was a dream. So decided to go with it. And I've been in London for the last 7 years now. First working at Cube and then launching my own firm with backing from previous partners at Cube in 2016, late 2016.
So did you know at 21 you wanted to be an investor?
I think from the back of my mind, probably around 16, 17, I definitely wanted to do economics and math. Those things that I liked, and also philosophy, which was the other one. So I went to university here, which specializes in basically those 3 subjects. Did that, and I knew I wanted to get on a trading floor. I just didn't know really what I wanted to do. So when I got to Cube, I did literally everything they gave me, from analysis to building Excel models, like anything I could get my hands on, just like try. And over time, they were the ones who pushed me into trading there. So they hired me first as like the assistant trader, and then I grew into trader, running my own book. So it was a fertile ground for figuring out what I wanted to do.
What years were this?
So 2011, 2012, 2013.
And can you tell us more about your experience there?
The fund, as it was structured, Cube, was a multi-manager asset management firm. What it did was it would construct a top-down view and then would express it either directly through internal books or go and allocate to other managers. So what I did there was I ran the macro book for them over 4 years in cooperation with the CIO and the head PM. And so what I did there was everything from trade expression to managing the actual risk to building macro models. So I did the whole spectrum of the macro analyst to the trader to the guy who was managing the risk on a daily basis.
But how did you come about to your style? Like, were there any influences? Like, how do you decide what sort of investor are you?
I have something which I share with a lot of people in my family. I drown in books. So I think that's definitely one of the influences. So if you come to my house, there's just like books lying everywhere. So a lot of reading helped me to understand what the other macro managers were. Another exposure there was, since they had a fund-to-fund business there, I was able to meet other managers and understand their process, et cetera. But it was a lot of trial and error as well. I mean, one of the great things at Cube, and one thing I'm extremely thankful for, was as long as you had a smart, well-expressed idea, you were able to go through with it. Now, again, like I like to say, they give you enough rope to hang yourself, so you can't, make that many mistakes there. But they were able to tell me, go for it. And that is, I think at my age, was a fantastic thing.
So how did you perform between your time there when you actually began trading?
Yeah, so I've been annualizing return at around 18, 19%. So it was.
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
So how did you perform between your time there when you actually began trading?
Yeah, so I've been annualizing return at around 18, 19%. So it was a good couple of years there. To a certain extent, like the market was definitely very good for me when I was there, because I came in with fresh eyes after the crisis. youth and naive. So being able to, take positions in stuff that other people had been burnt in the crisis, which I didn't have that stigma on me. And I think that's helped me. Question is, will it help me in the next downturn? But definitely over that time, it certainly helped.
What were some of the themes you captured?
Big themes, short volatility, 2012 onwards. I mean, that was like the biggest part of our book. I mean, we were short variance swaps in the US for ages. It was a great carry position, rolled down perfectly, easy to manage the risk on that. We did a bid in long dollar position in 2014, which was another one. Completely missed the commodity sell-off, though. But long dollar was definitely one. Transitioned more into EM shorts also at that time. So we traded really well in terms of those little hiccups that were happening. But broadly, I mean, if I have to classify into one thing, I mean, it was short volatility from like 2012 to 2015.
And then Cube set you up, encouraged you to get out and set up your own fund.
Yeah, so again, one of the other great traits of Cube is that they really push you to try stuff. And so in late 2015, I was interviewing for other firms and, let's say having a hard time during the interviews with some of the people. And one of the partners at Cube told me, why don't you try and set up your own fund and launch it? And, I think I always had that entrepreneurial spirit, or at least I like to think I did. And going through the process of taking a year and a half to figure out what is the best structure to launch a fund, how do you manage the fact that you're going to be alone, you're going to need all those external services for what you're doing because you can't hire anyone, and you need to manage it like an institutional shop, or at least try to manage it like an institutional shop. It was a great challenge. At least I told myself, look, try to formalize a real business plan for the fund, give yourself a year. A year after that, put it into place, or don't if you figure out it's a bad idea, but actually take that time to do that.
But before launch now, you've been managing capital for about 4 or 5 years.
Yeah.
What would you say was your investment process? How do you define yourself now?
Sure. So my investment process has always been a checklist approach, if you will. So I always did first off, starting from a long-term thinking, macroeconomic, discretionary way. So, inputs of qualitative, quantitative, trying to get a firm grasp or a firm scenario analysis of what the future is going to look like, right? But in the short term, trying to trade that as tactically as possible. So we'd go through this checklist approach of how are the technicals, and we would rank that. So I built a whole model for ranking technicals on all the asset markets that we were looking at. How is the fundamental value or fundamental driver? And then we would split that into what is the carry, what is the momentum, and what is the mean reversion potential of those of that trade. And the last part would be, how is the narrative? Is it positive? Is it negative? Is it likely to get resolved in the future? And so we would build this database of trades that we would rank by score, and we would allocate capital to the trades which we had the most confidence in. So usually what I would run was a book of anywhere between 5 and 10 positions, so quite concentrated book, but very actively traded.
And the time horizon would be?
The themes would stay for more than 18 months, usually, but the active trading of it would be anywhere from 2 weeks to 6 weeks.
So in the books that I'm sure we've both read that have influenced us to get into markets, back then, old school macro was all about capturing return.
Yeah.
The latest generation of investors, and particularly since 2008, it's more about controlling risk.
Yeah.
So how do you think about this debate, and how do you yourself manage risk?
One of the things in the books that we both read that says that when you're young, you try to build confidence, right? You're coming new to the market, you can be quite cocky. Then you take a big slap in the face. Hopefully you're able to get back up, but from that point on, you try to build confidence, right? So I understand why at a younger age you manage more risk than you go chase the returns. Now, how come the managing risk has come down to those such low levels? I think it's a function of the market structure as it is currently, right? When you had 10% rates, it's easier to get to 10% in the first place than it is currently. So that's one thing. But also you have constraints from your investors. I came about in investing in a world where the investor constraints were managed risk. So my trading came from that, right? I I didn't come about in the investment world in the 2000 go-go era where everyone was just like pushing risk to the max, or even before that. So that's how it's formed my view, definitely. So one of the things I do is that every single position has a stop in, and I never risk more than 25 basis points per position, which means that I will have a lot of small hits constantly. And then if you look at my P&L structure, basically what it does is I do nothing for a good couple of months, and then I have a blowout month. That's the way I trade. Large position, tight stops, tight risk.
And just for the benefit of viewers, the books we're referring to, Market Wizards?
Yeah.
Any others you'd recommend?
Well, my Bible, absolute Bible, is George Soros. So The Alchemy of Finance, because loving philosophy, this was just like the guy's combining everything.
Which book do you think actually is the best Soros book?
Alchemy of Finance.
Really?
Oh yeah, for me it's...
Not Soros on Soros?
No, Alchemy of Finance. Because he goes through that experience of like taking notes about what he's doing, and you see the thought process coming through. I mean, that book is just...
Have you read Sebastian Mallaby's More Money Than God?
Yes, yeah.
That was one of my favorites.
Yeah.
I think Steve Jobs done a great job as well.
Yeah, definitely. The Invisible Hands, and those books where you're able to see the thought process of the investors behind, is just, I mean, write more of those books. Like I'm looking for those.
I think Real Vision is sort of
Definitely, yeah.
filling that gap. Now you're getting a lot of acclaim recently for your well-deserved analysis and insight on the retirement crisis, potentially, with the baby boomers reaching retirement age. Can you share your thoughts in more detail?
So first off, like, giving back to Caesar what Caesar deserves. Mike Green was definitely one of the person that put me onto this. Now, I did do a lot of work after that. And that's one of the good things about Real Vision, right? You're able to get insight into how these people think, and then you're able to do your own work behind that. So, boomer retirement crisis, right? I think back in the mind of a lot of people, been talking about it for ages, but what triggers it? So this year, first year where people first boomers turn 71, 70 and a half, 71, by law, they need to start dispersing asset. I think that's been discussed. So required minimum distributions, they need to sell down a portion of their portfolio every year by law. Question becomes, do they use that money to fund their retirement? Or do they actually just take that out of the tax-deferred account and then just reinvest it? So one of the big things that doing my research has shown is that you actually see that the good example is 2009. 2009, there's a postponement on required minimum distributions. And so you would expect people to say, okay, I don't need to take the money out. This is a bad time. Leave it in the account. What actually happens is that you see more than 70% of the accounts have to take that money out. Why? Because they need it to fund their retirement. So you have that natural outflow, which is happening. And then on the other side, the younger boomers from 52 to 70, they're shifting the structure of their portfolio towards less volatile asset. That we've known about, but it's just accelerating.
So how does this play out?
That is the good question. Of course, it's all fun to be writing about macro news, but how does it play out in the markets? I think what happens is that you have a compensation of that outflow from somewhere else. So the easy answer would be to say equity markets go down for the next 10 years, right? Until the younger cohort, my cohort, comes in and starts saving. The more complicated answer is to say there's going to be another inflow which is going to be created to compensate for that. And so the big question I'm asking myself is where that inflow comes from, and I need to be aware of when it comes in. So in the meantime, where can it come in? Further share buybacks, right? Corporate de-equitization, which we've seen and probably continues. Inflow from foreigners, but goes contrary to the thinking of closing down the current account balance. And a bit of more left-wing central bank buying. I need to be cognizant that a potential inflow will come to compensate that. And so the only thing I'm doing right now is trying to figure out signposts if something's compensating that. Right now, I know there's an outflow. Look for the inflow. Right now, I don't see the inflow. So as long as I don't see the inflow happening, I would have a bias from March to start being short US equities.
So the fundamental argument is there'll be more supply
Yeah.
of stocks than demand for stocks, which means prices should be lower. Let me just throw something at you as well, because not every time is it that supply-demand dictates prices, right? So I'll take an example of oil. I don't know if it's correct or not, but oil supply is more than demand. It has been even for the last year, yet oil prices are rallying. They're up. So it's not always that you'll have a deficit and prices will go down, or if you'll have a surplus, and I mean,
What
how does
percentage?
that?
Okay, so what percentage of that market is financially driven or not? So that's the whole question that we have, right? So if you have permeating financialization of a market, right? So then you need to look at what's driving that financialization. So oil is a good example, right? You have fundamental demand and supply. You know that one is greater than the other, and yet the market doesn't adjust directly for that, right? But you have such a big financial part, well, just pure financial trading in there, that you need to be looking at what is the actual supply and demand in the financial trading of that contract, right? Same thing for equities. Like if you ask me back what was the driver in the 70s and 80s when before there was this financialization of, retirements, basically. I think fundamentals drove, or what the investor's perception of fundamentals drove the allocation. But if you look at from the installment of 401ks, IRAs, that flow just trumps everything else. Like if you pull up a graph of people allocating to tax deferred assets over time, or so 1980s to now, I mean, it just drives. You see it. Correlation is not causation, but you do see a big flow coming in. That flow is reversing. I just think you need to be able to figure out what part of the market is driving it, right? And right now we know that passive flow has been driving the market. Maybe that changes over time, but right now I think that's where you need to figure out what the supply and demand balance is. And we know that the supply selling on of shares is going to increase versus the demand for shares.
So I completely agree with your analysis and your thinking and approach of that signpost, because it's not all black and white. And I think part of the outflows will be matched by buybacks. I think that's only going to last a couple of years, because we've already seen significant buybacks that have sort of but weakened corporate balance sheets. Plus, if you're going to have equal playing field between debt and equity, the incentive actually is no longer there to continue to issue debt to buy back stock. But I think for the next couple of years, you could see buyback inflows. You're already seeing, at least in the latest reported data, foreign buying of US stocks pick up. So it seems like, at least for the first 2 years, where people are just trying to figure out what this baby boomer selling means, you could see an offset from at least narrative perspective that buybacks and inflows from foreign countries makes up that difference. But once we get beyond 2018, 2019, if the earnings stop, or if the economic expansion gets long in the tooth, then I think that's probably when you'll see selling overwhelm the demand, and the retirement crisis sort of fueling an accelerated decline in equities. Somehow I feel the risks are pushed for the time being.
Well, I mean, for the time being, you're completely right. I mean, just look at the performance of the equity market. It's still going. But what I find interesting is the following. We expect outflows from equities by boomers to be about $400 billion this year, right? We kind of have the hint that the Trump administration wants to close down the trade balance, right? What's the opposite of that? What's the opposite of the trade balance? The financial account, right? So if we're talking about increasing foreign inflows into U.S. equities, then mechanically, the trade balance is going to increase, right? It's a simple equation of the current account and the financial account. So there's these opposite, forces that are pushing each other. So Trump wants to close down the trade balance. How is he going to be able to do that when you have inflow of capital into the country? There's so many things that go counterbalance, that are pushing in the opposite direction at the same time that you have that boomer outflow. So if I think about the rules that are pushing for equity financing in the U.S. By the Republicans rather than debt financing, they want to close down the trade balance. I mean, how these two things are pushing in the same direction that the boomers are selling down their assets. I see the potential for a big risk, actually, to be sooner rather than later. But once you have that downturn, and if it's able to sustain, once you have that downturn, I completely agree with you, it'll just accelerate the flow.
So it's important to focus right now on the sequencing
Yeah.
of how this plays out. And I think what you said about Trump and the current account and the financial account is particularly something to watch. Another thing that Mike Green got me onto was figuring out where's productivity. Because if we're going to see this economic expansion continue, we're running out of labor supply, you need to see productivity show up if this bull market is going to continue. That's something you and I have had conversations with. Can you, sort of share your views on productivity, which I think is an extremely important and undercovered issue going forward?
I think it was Robert Solow that first talked about it, right? So one of the main drivers that he found when he was calculating GDP was that you had this labor input, this capital input, and then they had this residual, right, which was productivity. And they were quite amazed by the fact that this residual is just actually driving the whole of GDP growth over the 70s onwards. And so how can it be a residual? So this is productivity, what they call technological productivity or whatever. So we get to the 2000s and later on, and what we see is that measured productivity, what they call total factor productivity, is just going down. And this confounds economists. Like, how can this happen when we've had just the biggest data-driven industrial boom? We should be having massive increases in productivity. And so the whole debate has shifted to, actually, we're probably mismeasuring the productivity. So a lot of people started saying that we're just not measuring the actual productivity of the industries, and that the industries that were the most productive were actually taking a lower share of GDP. So even if those industries were super productive, they were driving the price down, productivity is going up, and you have aggregate productivity, which goes down, right? Then you had people like Mike Green who were saying that actually productivity was mismeasured in the previous period. So we're not actually having a lower productivity, it's just that the previous productivity period was mismeasured and was higher than what it was expected to be. My point of view is starting to shift towards something different, which is non-natural profits by corporations actually drive down productivity.
Can you describe what you mean by non-natural
So
profits?
What I mean by non-natural is oligopolistic or monopolistic profits drive down productivity, because it means that you are inputting a certain premium on something which should have a lower price, right? So it should lower down productivity. And when you see businesses like, businesses that are driven by the philosophy most pushed forwards by someone like Peter Thiel, of you need to dominate the market. And we see that in companies like the Facebooks, the Google, like they dominate their industries. That drives up higher profits than what the actual cost of production would imply, and thus drives down productivity. So I'm going back to Adam Smith, because Adam Smith actually wrote about that, writing about landlords or landowners in general, and how they would drive down the productivity of a nation by extracting rent from the rest of society. So that's the direction my research is going into right now.
So how do you deal with the shortage of labor supply, and how much economic recovery can continue going forward, in your view?
Yeah, so how much economic recovery can keep going forward? I think take a look at, so coming back to France, if you take a look at France, how much labor supply is actually there, and you actually see there's a big pool of supply of labor that just is unused, and they can't get access to jobs, and for several reasons. You pull that into the economy, then suddenly you have higher GDP growth. If you look at the US, I struggle, and I've been confounded by the NFP numbers over the last quarter or so, where they just keep pulling people into the workforce. And I think over time, I don't see that continuing very much longer. I would expect labor force growth to actually just keep going down towards close to zero by the end of the year. And thus, economic growth as represented is not going to be as good as what we're expecting.
And this is why productivity becomes so important.
Yes.
So now, do you think in whatever traditional way, shape or form, we see a pickup as could have been expected 7 years after the crisis, a pickup in capital spending intentions with real spending coming?
When I see it, I'll believe it. Hasn't happened, right? We see capacity utilization still quite high, well, still quite low actually. So I don't see that capital spending part. But now, if we're able to reallocate profits from corporations towards labor, productivity mechanically goes up, right? And I think that's the big trend change. One of the big narratives that I impose on the data that I look at, because that's all we do, right? We look at data and then we impose some kind of narrative on it. 1980s, we have Margaret Thatcher and Ronald Reagan come into power. They make capital earn more than labor, right? Productivity starts going down from that point on. It has a little boom, but actually goes down over time. I think one of the consequences of populism rising across the world is that we have that reverse starting, where the share of income that goes to capital shifts towards labor. So we might actually see productivity pick up just from that. But we need to see that share of income towards labor actually increase versus capital.
So you write an insightful weekly commentary, and one of the things I read was macro is conviction and timing. So what are some areas of the market where you feel strong conviction right now?
So we're after the French election, and one of the areas where I feel strong conviction is to be long dollars again, right? One of the areas that's been pushed back since Q1. I think I have my timing right because we've taken out one of the risks, which was, I think, pushing dollar down or actually taking away a potential impetus for higher dollars. So that's where I have conviction right now. So we've shifted the book completely 180 since the French election from short dollars to long dollars. How do you solve for timing, right? So the way I trade, I need to be able to have almost perfect timing because we trade relatively large positions, but we curtail our risk with stop losses. So one of the ways I build conviction through my research, and then my trading enables me, or the way I trade, to solve for that timing problem, right? To be able to get in and get out of a trade and just push it constantly. So long dollar definitely one of the areas where I have strong conviction and hopefully timing.
What about the fixed income market? A lot of people are talking about a secular turn in interest rates and inflation. Something you believe?
Yeah, I mean, so first of all, interest rates never been my forte, and I think by doing a lot of introspection in terms of trading, realizing the last 5-6 years of trading, I know that's not an area where I'm the strongest, so I tend to trade it in smaller size, hence lower conviction. So always lower conviction on the fixed income market.
What about Trump? A lot of people seem to be confused by him. What's your take? Basically, we've been in a world where central banks have dominated for the last, since post-crisis. Now, frankly, I think the Fed and other central banks are irrelevant. Just the way we used to watch monthly FOMC meetings and all speeches, now everybody's focused on Trump's tweets.
Yep.
So he's definitely taken the center stage in the dialogue of market participants, right? So you must have some sort of an idea, perspective on what he means for markets, what he means for the world, and particularly for us as investors, how we position our portfolios. So when Trump comes to mind, what are some thoughts?
So the first thing I always think when I look at this, and I thought that of the FOMC previously, is that they drive the narrative, okay? And they can either be, my point of view is that they're a post facto explanation of the move rather than the actual fundamental driver behind it. But I can understand the different view. Now, what kind of impact does Trump have? I think the broad one people have talked about, you've talked about, is multipolarism around the world and what kind of instabilities that creates in the relationships that we've taken for granted, that I personally have taken for granted since I was born. There was some kind of hegemon driving everything, and that is quickly going away. So he has an impact, a fundamental impact on that, and I think that leads to a more, actually a stronger Europe to a certain extent, which is in reaction to this person on the other side, which is, putting the status quo, exploding the status quo of, we'll protect Europe, whatever happens. Now Europe says, I have to fend for myself, so, I'm going to actually build up my external power. So that's definitely the big impact I see. Now, in terms of following him and in terms of what he says, I think the general template is the same that we've seen for previous Republicans, which is constantly higher deficits. And I think that's potentially also what drives economic growth in the future, is like just fiscal spending. So maybe in the short term he doesn't do anything, or he has a hard time pushing stuff through, but I am confident that the next downturn happens or any kind of market hiccup happens, and he will have the floodgates open for him in terms of fiscal spending. So in the short term, I think he's more geopolitical risk. In the longer term, I think we have to be cognizant of the fact that he will step on the fiscal accelerator as soon as he needs to.
And the hope or the market expectation is, I guess, less so now with the healthcare fiasco, that this will be carried out, signed into law this year. And you think legislative delays are going to continue?
I'm not the biggest expert on that, but what I would take is, what is the market expecting? The market is definitely expecting delay there. So the market has shifted one way. It's always a good idea to take the opposite view when it's gone extreme, I think. It's not contrarian for the contrarian's sake, but once you have examined the power structure as it is in the US, where you have, a president in the White House which is Republican and a Congress which is fully Republican, I mean, I think the potential for him to do more than the market expects is actually quite high. Just because the view or the prevailing narrative of the market has shifted back to one other extreme.
It's almost like we had good Trump with post-election surprise market performance, and now we're tilted towards the other side. Yeah. Any other interesting themes that you're looking at that would be interesting for viewers?
Yeah, so I'm always focused on where I live. So the UK is always something I'm looking at. As any foreigner living in the UK, interested by the rise of Theresa May, and Brexit, post-Brexit. I'm fascinated by the way the real estate market is performing still in the UK. So the potential for something, I think I have an idea where the instability factor is in the UK, and it's always been the real estate market. So that's one area where I'm putting more research into, trying to figure out what kind of impact Brexit will have on the real estate market, and by consequence on the rest of the financial market in the UK.
And for the currency, we were speaking earlier, you mentioned you're short euro against the pound.
Yeah, yes.
That probably has fundamental legs to it as well.
Yes, yeah. I think right now we've shifted from the uncertainty of Brexit and the post-BAT scenario being priced in towards something which actually has more legs than people expect in terms of the inflation dynamics in the UK, pushing the central bank to hike faster. I think that's something that's going to be unexpected, and that is going to push the market, especially for sterling, much higher.
And with the early election and a potentially strong victory for May, that supports the trend.
I mean, strategically, it's fantastic what she did. Like, said she wouldn't call for new elections, gets the Brexit deal on the road, and still has no economic downturn in the UK, and thus calls for a snap election. I mean, how more strategically minded can she be? It's fantastic. So the hope for her is that, in her view, is that there's no downturn over the next 3 months, which pushes people towards the Labour Party. I don't think that happens. She probably gets a landslide. Once she gets that landslide in and has the House of Commons behind her, she can push through her agenda of, again, a similar type of approach of shifting returns from capital to labor. I think that's the broad dynamic that we're seeing in the different elections, where it'd be the US, UK, and potentially Germany, remains to be seen, where we have this broad ending of we need to remunerate capital as much as we can towards there should be a more balanced approach. And it's funny because it's coming from what we're calling more right-wing candidate, whereas those used to be left-wing policies. But in the end, they're there to satisfy the people.
So we've talked about different countries, different themes. What sort of drives you in what you do? You've got a philosophy background as well. Tie it in for me, the viewers, about what sort of excites you, makes you passionate about what you do.
So a couple of things. One, learning constantly. I spend more time thinking about what I don't know than thinking about what I do know. That's the sole focus of what I try and do. Like where do I have a blank spot? And so I think hedge funds and trading markets is just a constant learning process, and I want that for the rest of my career, my life. And it ties back into just constantly trying to gain some kind of transient knowledge. So it looks right at this time, but it might change, and you might be able to adapt that reality over time. So that is one of the big drivers. The other big driver is like being able to discuss with people like you, Mike Green. In the end, what I thought was an industry which was quite closed down with people unwilling to talk to each other is actually turning out to be something where people are much more open than what I expected. So that communication with people is something else that I enjoy quite a lot, and that intellectual debate, I think, is something which I love.
I think the other interesting part of what we do also is that you can test out your knowledge and your thesis in the market real time.
Yeah.
Right.
Yeah.
So it's not just intellectual soirees, but actually really seeing whether you're right, whether you're wrong, and that introspection that we discussed earlier is so crucial to what we do. Sam, I'm super excited with your new venture, and I wish you much success. Thanks so much for taking time. All the best.
Thank you very much.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.